Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning. Welcome to the new business week and a new week of Money Talk. This is Peter Lewis with an update on the main business, finance and economic news from around Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, President Joe Biden's administration is poised to unveil a sweeping decision on China tariffs as soon as this week, one that's expected to target key strategic sectors, while rejecting the across-the-board hikes sought by Donald Trump. Officials are particularly focused on electric vehicles, and they're expected to raise the tariff rates to roughly 100% from 25% as they intensify efforts ahead of the US election to protect American industry. China's consumer prices rose in April for a third straight month, while producer prices extended their declines, suggesting an ongoing recovery in domestic demand in the world's second largest economy. The consumer price index edged up 0.3% in April from a year earlier, accelerating from a rise of 0.1% in March. The producer price index dropped 2.5% in April from a year earlier, easing from a slide of 2.8% the previous month and compared with a forecast decline of 2.3%. It marks the 19th straight month of contraction in factory gate prices, underlying persistent economic uncertainty despite multiple support measures from the government. Chinese banks extended 0.73 trillion renminbi in new yuan loans in April, far lower than economists' estimates, and declining sharply from 3.1 trillion in March. The latest figure was the smallest amount of new bank credit since July 2023. Meanwhile, total social financing, which is a broad measure of credit and liquidity in the economy, logged a negative reading of 200 billion renminbi. That's the first contraction since January 2002. US consumer sentiment data released Friday morning showed a big uptick in inflation expectations. Preliminary May reading for the University of Michigan's Consumer Sentiment Index came in at 67.4, far below economists' estimates of 76. And marking its lowest reading since November. The one-year inflation outlook jumped to 3.5%, up 0.3 percentage point from a month ago to the highest level since November 2023. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and John Schofield, Managing Director of Tempus Investment. Providing a view on Mainland China is China specialist and author Mark O'Neill. And if you want to have a look at the latest updates of my Asian business and finance newsletter, it's posted now at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Friday, US stocks ended the week on a high note. However, enthusiasm was kept in check as a report showed US consumer sentiment declined to a 6-month low as short-term inflation expectations picked up. The Dow concluded an 8th consecutive winning session and registered its best week of 2024. The 30-stock index added 125 points, or 1/3% to close at 39,513. The S&P 500 climbed 0.2%, ending at 5,223. The S&P 500 traded less than 1% away from its all-time high, advancing to its highest level since early April. The Nasdaq Composite inched lower by less than 0.1% to end at 16,341. The major averages all posted gains for the week. The Dow recorded a 2.2% gain for the period, its best week since December, and its 4th positive week in a row. The S&P 500 and the Nasdaq Composite both posted a 3rd consecutive winning week, rising 1.9% and 1.1% respectively. Treasury yields extended gains after consumer data released Friday morning showed a big uptick in inflation expectations. 10-year Treasury yields rose 4 basis points to 4.5%. 2-year yields reached weekly highs of 4.87%, up 5 basis points on the day. The US dollar index was mildly firmer Friday in what was a quiet session for FX. The Japanese yen was 0.1% weaker at 155.72 yen per dollar after household spending data topped forecasts but showed a steeper contraction year on year. For the week, the yen lost 1.8% against the dollar. The offshore yuan weakened 0.1% to 7.2261 renminbi per dollar, influenced by reports of increased restrictions from Washington on Chinese goods. Spot gold was up 0.6% Friday at $2,360 per ounce. For the week, it rose 2.5%. Brent crude oil prices dropped 1.3% to settle at $82.79 per barrel on Friday and was down 0.2% on the week. Bitcoin and Ethereum fell after that US consumer sentiments report. Bitcoin was down 2.6% at just above $61,000. On the mainland, the Shanghai Composite Index was unchanged at 3,155. For the week, it was up 1.6%. Hong Kong stocks led Asian markets higher on Friday. The Hang Seng soared 426 points, that's 2.3%, to end at 18,964, rallying for the second day and notching its highest level since August the 11th. The index surged 2.6% over the week, its third straight weekly rise. Futures markets pointing to a decline of about 100 points for the Hang Seng at the open should start the day at around about 18,865. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let me introduce our Monday morning guest to you. We have with us Alex Wong, Director at Alex KY Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also with us is John Schofield, who's Managing Director at Tempus Investment. Morning, John.
Yes, hello, good morning, Peter.
Several media reports are suggesting that President Joe Biden's administration is poised to unveil a sweeping decision on China tariffs as soon as this week and maybe tomorrow, one that's expected to target key strategic sectors, but rejecting the across-the-board hikes which have been proposed by Donald Trump. The decision is the culmination of a review of so-called Section 301 tariffs. They were first put into place under President Trump starting in 2018. The new tariffs will focus on industries including electric vehicles, batteries and solar cells, with existing levies largely being maintained. An announcement scheduled for tomorrow, according to the Wall Street Journal, and officials are particularly focused on electric vehicles and are expected to raise the tariff rate to roughly 100% from 25% as they intensify efforts ahead of the US election to protect American industry. It represents one of President Biden's biggest moves in the economic race with China, and it builds on his call last month to hike tariffs on Chinese steel and aluminium, and also the formal launch of a fresh probe into China's shipbuilding industry. Alex, first of all, what's your reaction to this news of a sharp increase in US tariffs on some goods, narrowly tailored, they say?
Well, I think that is not too surprising because Chinese EV actually are too competitive for the US now. So I think they are targeting several areas which they feel threatened, but not across the board because I think they still probably would have some concern for inflation in the domestic market. So I think this targeted tariff actually is not too surprising, and I think not too damaging for the market as a whole, because I think right now the exports only accounted for not too much percent of those Chinese EV companies right now in the US.
So you see this as purely a protectionist move, just designed to protect the US car industry. It has nothing to do with oversupply or overproduction, because there's a big market for electric vehicles, isn't there?
Yeah, I think if they are labeled as a Tesla, then they probably would not mind that oversupply situation. But now Chinese are selling on their labels, so that's why they are very concerned about these labels. I think this overproduction, the things.
What's your reaction to this, John?
Yes, I think it's in a sense good news in that targeting. There's no point in targeting industries where China has already swept the board or targeting further, like the other new energy, solar panels, wind turbines, etc. But very topically focusing on the EV issue, which is has been surfacing at the highest political levels in Europe also. So this is probably the last bubble. It's preemptive in the sense that this expected wave of exports flooding out of China into the West has not yet really taken off. So let's see what's happened there.
I suppose, I mean, it's not as bad as the 100% across-the-board tariffs being proposed by Donald Trump. So do you think there'll be some relief about that amongst investors?
Yes, I do. I think because it's just focusing narrowly on areas where it can make a difference to the domestic industry without completely tearing up globalization. And that's where we've come to. This is the end of 2-3 decades of the advance of globalization. It's now
it's come to a screeching halt, hasn't it?
Well, it's plateauing. It's reached the limits of the possibility. You can't have one country dominating almost all sectors of manufacturing.
Alex, this is in effect going to completely shut out Chinese EVs from the US market, isn't it? Because there's no way they can cope with 100% tariffs. Maybe with 25%, perhaps they thought they could, do something and wait and hope the American car industry collapsed or something. But at 100%, there's nothing they can do, is there?
Well, I think they actually can do something. If you look at the cheapest EV in China, actually they are so cheap. So even with 100% tariff, actually, they are still comparatively cheap, actually. So I don't know, yeah.
What will be the impact on Chinese EV manufacturers of this?
I think with or without this tariff, Chinese EV actually is a very crowded and over-invested sector already. So I think there will be some consolidation with or without this tariff.
But the majority of Chinese electric vehicles aren't sold to developed countries, are they? They go to emerging market countries. Right. I think about 2/3 of them go to developing economies. So presumably they'll just increase their sales to those countries. They're not going to run out of markets to sell into.
Yeah, right. You're absolutely right. I think they actually have other global markets to play with, yeah.
So, John, we don't really need to fear about the Chinese EV manufacturers, really, do we? There's a big market for them.
Well, I think, as Alex said, it's basically a bubble in China. And something is going to prick that bubble sooner or later. Then we have consolidation, and then the survivors will be able to move forward and grow their business and hopefully make some profit.
How are the foreign manufacturers doing? How are they going to compete? We see data from the CPCA showing that Tesla's lost ground now to local electric vehicle brands in China. Its market share dropped 2.6 percentage points from a year earlier to just 4% in April. And its April sales volume was down 21%, even though overall EV sales in China are up 28%. How are firms like Tesla going to compete? Are they really losing market share rapidly now?
Yeah, I think they need to compete on quality or on a brand equity. I think this is just like Japan in the past. I think several decades ago, actually, Japanese actually is flooding the global market as well. So I think they need to learn the lesson from that history and then try to compete on the quality ground. I think if they need to sell at a premium, I think they need to have some quality features to compete with Chinese.
Can they do that when there's this really ruthless price war going on the mainland, isn't there? Is there some distinction for quality, or is it all about price?
In the local market, I mean, in the China market, actually, the public can do little because actually Chinese actually probably would not care about too much on the quality difference, and I think they probably would go for the local brands as well. So in the Chinese market, actually, it would quite difficult for foreign brands to compete now.
Yes, and I agree. It's been the market investors have been quite concerned about Elon Musk's strategy, particularly this year, in trying to compete with China on their own grounds, i.e., aggressive price cutting. And when he started that, I think he started that in sort of January. I think with some very aggressive price cuts, that will tend to undermine the perception of the brand, and. So yes, I think they need to reset.
Is he retrenching in China? I mean, there's a lot of talk about job cuts, aren't there? We don't quite know the impact in China of that. But
yeah, it's not very clearly enunciated what exactly they're trying to achieve as yet.
European companies in China, they're also finding it harder to make money in the country as growth slows and overcapacity pressures increase. That's according to a survey released Friday by the EU Chamber of Commerce in China. The chamber warned that European businesses are at growing risk of structural decline in China and other markets as they face head-on competition from Chinese rivals increasingly moving up the value chain. I mean, this was a big focus of discussion, I think, last week, wasn't it, when President Xi Jinping was in France. But it doesn't seem to be just a China phenomenon. It seems that, EU companies, European companies are losing ground around the world, particularly in developing nations. This presumably is going to be a big challenge going forward.
Well, actually, Hermes is doing quite okay in China, and their sales actually pick up quite strongly. I think overall, Europe actually has need to focus more on brand equity. I think that is the history, and also they have several key industries doing quite well, especially in the defense. I think that is still the place which they are very competitive. But overall, I think goods selling for middle class or brands which are not at the premium level like Adidas probably would face more competition now.
But presumably they're not going to be able to compete in things like the manufacturing sector. So as you say, it's got to be things where there's a quality name, a brand name that you can sell at a premium.
Yeah, right. I think probably the auto industry is feeling threatened now in Europe. So that is also the same story as Tesla. I think that is an area which probably Europe is facing more difficulties right now.
I mean, Ursula von der Leyen was saying last week when President Xi Jinping was in France that basically EU companies need protection from Chinese imports. But I don't think President Xi is going to do much there, is he?
No, clearly not. His very recent visit to Europe is to try and soften up the resistance. The strategy of focusing on these three new industries is, that's it's how shall I say? It's a philosophical thing, really. That's how China's always competed. Grow your market share as quickly as possible, competing by at the expense of margins and so on. Whereas in the West, it's the opposite. So you've got these two conflicting strategies in opposition. Finally, we start to see, even in the US, some form of a national strategy, industrial strategies. And there's a lot of talk about that in Europe as well, including the UK. But the US have done it by just focusing on these two key areas of the chips, advanced chips and so on, making sure that they keep one step ahead at least of China in that area. It's the last sort of frontier, if you like.
Now, we have some data out from China over the weekend. First of all, China's consumer prices rose in April for a third straight month, while producer prices extended their declines. The consumer price index was up 0.33% in April. That's accelerating from a rise of 0.1% in March, and it was above economists' forecasts. The producer price index, that dropped 2.5% in April from a year earlier, extending from a slide of 2.8% in the previous month. Alex, what's it telling us about consumer demand here? Are you seeing signs that maybe it's picking up?
Well, at least we are showing some positive signs. Finally, I think one of the biggest threat in China actually is deflation. So at least we are seeing some signs that China is not in deflation mode probably. So this uptick in consumer price index actually is encouraging. So and for the PPI, I think we have seen this kind of decline 1 decade ago. I think that means actually China is in a overcapacity right now, and that I think can need very long time to correct. So probably the PPI would still be under pressure.
But it's not good for the manufacturing sector, is it? That PPI.
Right. I think probably some quality in manufacturers would be okay, but overall the sentiment towards that sector would not be too good.
John, what are your thoughts?
Yeah, well, the PPI, yes, that just confirms that, it is a bubble in the manufacturing sector. But it's good news that the rest of the domestic economy is starting to stabilise, and we get this slight uptick in CPI. So that the property, the debt and property bubble obviously is well and truly burst, and now gradually we're going to start hopefully seeing more measures to stabilise the property market, and that in turn should eventually feed through positively into domestic demand.
It seems, what the data seems to be also telling us is that Chinese companies, they produce a lot, but they don't make a lot of money because prices are falling. This is their problem, isn't it? We see that in the industrial profits. They were down, 5% in the first quarter.
Yeah, well, this has been a trend for decades, as I said earlier, and we're sort of seeing the peak of that. What do you want to call it? That sort of market share driven strategy. So I mean, I don't know how it's going to end up. Currently, it's being still supported, of course, by the central government, with more and more emphasis put on the manufacturing sector to sort of compensate for the problems in the property sector. But it's just creating another bubble. It may sound a bit odd to talk about a bubble where you've got prices falling, but that's effectively it's another type of bubble.
Alex, what do you make of the new loans data? That was down quite sharply, wasn't it? The Chinese banks extended just 0.7 trillion in new yuan loans, and that's down very sharply from 3.1 trillion in March. And total social financing has turned negative now, 200 billion. What's that telling us?
Well, I think this is because the property market actually has burst now. So that's quite difficult to make up that gap, I think, because right now I think people will not be lending towards the developers, and they need to find some replacement in other areas. So I think that's why the overall lending actually is quite difficult to stay at a relatively high level, because if you lend to other kind of business, actually they lack the asset backing. So that probably the bank would be more prudent in those kind of lendings.
And presumably the fact that you've got local government municipal debts is about $13 trillion US. That presumably is weighing as well, isn't it? Because it means they've got to really sort of restructure rather than start spending more money.
Yeah, right. That's another key issue. Yeah.
John?
Yes, indeed. The deleveraging process is starting to take place, but. Or starting to happen, but it's going to take, it's a multi-year project, that's for sure.
Okay, let's turn our attention to the US. We had some data also out of the US. Consumer sentiment fell to a 6-month low, according to data released on Friday, and there was a big uptick in inflation expectations. The preliminary May reading for the University of Michigan's Consumer Sentiment Index came in at 67.4. That was far below economists' estimates of 76, and marking its lowest reading since November. And if we look at inflation expectations, the one-year outlook jumped to 3.5%, up 0.3 percentage points from a month ago, to the highest level since November 2023. Also, the 5-year outlook rose to 3.1%. Although that was just a 0.1 percentage point increase, but nevertheless it's the highest since November and sort of reverses a trend of lower readings in the past few months. Alex, are we starting to see signs that maybe the US economy is starting to crack?
I think we are seeing signs that US economy is slowing at least. So it is not too bad right now, but I think there are some signs of slowing. But I'm not too concerned about the expectation of inflation. That probably is a lagging indicator. So people are seeing the impact of the inflation, so they adjust the expectation. But I think that is a lacking indicator, so I'm not too concerned about that. But anyway, I think they are, with the recent set of data, actually there are some signs of slowdown in the US.
I mean, it does show that the consumer's worried about things, doesn't it? Inflation, unemployment, interest rates, that seems to be the thing that's weighing on sentiment.
Yeah, right. So probably they would be more prudent. So that also would help to keep the inflation in check.
Are we also at the point now where the US consumer, they've spent all their savings, their pandemic savings that they built up, and they're also maxed out on their credit cards by the looks of it as well, aren't they, according to some of the consumer credit data? Is this going to become a problem going forward? Because consumer spending is the main pillar that's been holding up the economy.
Yeah, but that probably would be a good news for market. So that means the rate cut would be nearer, actually.
Yes, that's right. It's the sort of dilemma. The markets are desperate for the Fed to start cutting rates, but they're only going to do that once the economy starts to clear slow. So yes, this the controversy, if you like, whether the inflation or disinflation trend has now stopped, or slowed down, bottom out. The inflation has just been drifting sideways now for several quarters. So no progress below this sort of 3 point something percent level. Is that a trend, or is it just is that a new trend? I doubt it. I think probably, as Alex said, it will start to resume. The downturn in inflation will start to resume shortly.
Let's turn our attention to the markets. Here in Hong Kong, there was a report last week that China's considering exempting Chinese individual investors who invest in Hong Kong stocks through the southbound trading of Stock Connects from paying the 20% income tax on dividends, so as to avoid double taxation in mainland China and Hong Kong. It was reported that the plan's been submitted to relevant regulators, but there's still uncertainties over whether the plan will be finalised. Alex, this did seem to have an impact, though, didn't it, on Friday on the markets?
Yeah, of course, this is very positive for those high-yield stocks. So that's why we are seeing strength towards the high yielders. But the tax index actually lagged behind the performance of the HSI. So people are going towards those companies which are paying high dividends.
John, we're at a 9-month high now for the Hang Seng. It hardly seemed believable just over a month ago, really, did it? But if we look at what it's done, the Hang Seng, it's up 6.8% so far this month, and that follows a 7.4% jump in April. How much of this is down to the talk from the authorities about trying to revive Hong Kong stocks, things like attracting new investors from Saudi Arabia and so on?
Yeah. No, well, I mean that's all good, but I think we've seen the first the bottom of the cycle, at least as far as the market's concerned. So that's not uncommon. You get a very sharp rally in the initial move. At some point, we'll have a consolidation, but I think the downtrend has definitely been broken. And it's a combination of factors, extremely cheap stocks, plus a slight uptick in sentiment for the economy in general. Was enough to and then you get short covering. We know that most global investors have moved massively underweight to China stocks, but via Hong Kong. So now that's that sets the ground for where even a small uptick in sentiment will trigger quite a strong rally.
Okay, Alex, let's review the Alex Index. This, as regular listeners will know, was an index that we created for you back in September of 4 stocks that you thought were going to outperform what was at the time a bear market. It's an equally weighted index consisting of 4 stocks: HSBC, China Mobile, CNOOC and China Resources Power. Since September, your index is up 25.3% compared to a rise of 4.3% in the Hang Seng, so definitely outperformed. What I'm wondering, though, is Oh, you selected this index at a time, or these stocks, at a time when we were in a bear market, and you thought they were going to outperform in a bear market. How are they going to do now that we're in a bull market?
I think they will still outperform. I think one of the story which I believe most in Hong Kong is that the China financial institutions actually would allocate more on the high yield stocks in Hong Kong, because the yield or the yield on the RMB bond actually is declining. So they probably look for some returns, and they don't look. They don't want too risky assets. So I think companies with highest quality actually will still outperform, and actually the uptrend in those companies actually has been quite persistent. But if you look at the recent disposal of HSBC by Ping An, I think probably China Resources Power would be the one to outperform right now, because those three old stocks, I mean, the oldest three members actually probably are well owned right now, and I think there will be some profit taking after the strong outperformance. So very likely, I think people would have their preference towards some high yielders in other industries. So probably I think China Resources would be the one to support the index right now.
It jumped 5% on Friday, didn't it? Over 5%.
Yeah, and that I think fit the current global sentiment, because right now global investors actually are looking for opportunities in the power sector, because they think AI would be a very large consuming industries in the power sector. So that means that they would be paying high dividend and also with high growth later on. So I think this one probably would be the best performance amongst my index. But the other fees probably they would be slowing down a little bit. But I don't think they would have a big downside risk, and probably for long term, I think they would be still value to hold.
John, let me ask you about the US markets. They've notched their third straight week of gains now, and the S&P 500 is only about 0.8% away from a record high. I mean, it's really the resilience of the US markets has been pretty astonishing. But what's the outlook? Do you think that can continue?
Yes, I do. Whether it's going to relatively outperform, I think we're entering a period where other markets are starting to catch up in terms of relative performance. But I think this is quite interesting recently. The volatility, which briefly ticked up in April to around 20%, has fallen away dramatically again as of last week. So I get, and the indexes are sort of edging up towards the previous high. So the normal market side, when there's a signal to take the indexes to new highs, I think we'll see another wave of buying in the US. Also, we're seeing the same kind of effect of rotation now into more value stocks. The Dow sort of outperformed last week, which is outperformed the Nasdaq last week, which is quite interesting. And so we're seeing, the Magnificent Seven rally is definitely it's slowed down and consolidated, but also in general broadening out into other sectors, including financial stocks and even consumer staples and things like that. And dividend yield is increasingly a focus as well.
Alex, what's your thoughts on the outlook for the US markets?
I think it would be quite polarized. First of all, I think the Treasury remain quite weak despite the slowdown in economic data. So that would still be a concern. And so Russell 2000 actually continue to underperform, and that I think need any reversal in the bond market to boost that sentiment. And then if you look at ARKK, Tesla, actually they are super weak right now. So I think that people are looking for other kinds of growth story right now. So they don't like the disruptive innovation theme, and they actually are going for themes which are more related to AI, like I said, the power sector. And also I think traditional stocks, I like to point out, I think financials and some industrial actually will still continue to outperform. So we probably may see the index to be locked within a narrow range. Actually, if you look at the in volatility of the S&P index up, actually they are so cheap right now. So people are expecting the market to move narrowly. Even though we have some key data ahead this week, I think the in power actually is still too low for me. So that means I think people expect the market to remain quite quiet. So very likely we may see just a sector rotation, and some sectors will outperform a lot, and some sectors actually will be dumped. So the disruptive innovation theme actually is our favorite right now, and I think that probably will be some concern, because if you look at the support sector, they probably may not have too much. So that's kind of risk if you are an investor in the US, you have to be a little bit careful in selecting those kind of old favorites.
There was a report that Apple's closing in on an agreement to use OpenAI on its smartphones, and that there's going to be a release of ChatGPT features in the next iOS 18, the next iPhone operating system. How significant is that likely to be?
I don't think that would be too special for Apple. I think people are still concerned about the sales of the iPhone, and even with the AI features, I don't think that would change too much. But probably we may see some revival in the semiconductor side. I think on Friday we have TSM sales figure, and that boosts the overall sentiment for semiconductors, but that do not help too much in the overall market. So that means something actually to me. So I think the market would have some difficulty in picking out on either side. So this kind of news I think would be supportive for only probably a limited number of companies.
John, the IPO market seems to be heating up again, doesn't it? We had Zeekr, the Chinese EV manufacturer, priced at the top end of its range, $21 a share, and then it closed almost 35% higher on Friday. It seems that, despite all the geopolitics, there is demand for Chinese companies and particularly EV makers.
Yes, it's a bull market, so I don't know much about that particular counter, but yes, I mean there's been a drought of IPOs. People are looking to, the animal spirits of the market is certainly picking up as we've seen in the broader market. So yeah, that's a good sign for sentiment.
Alex, final thoughts from you? Any thoughts on Zeekr in particular?
Oh, actually, I don't understand. Because if you look at other EVs, actually, they are not doing too good. So I don't understand too much on this strength. So I would give it a pass and just stay away. Yeah.
Okay, well, thank you both very much for your thoughts this morning. You heard there Alex Wong, who's director at Alex K.Y. Wong Asset Management, and John Schofield, who is managing director at Tempus Investment.
Peter Lewis's Money Talk.
I'm joined now by Mark O'Neill, China specialist and author. Morning, Mark.
Good morning.
The big news over the weekend is these media reports suggesting that Joe Biden is poised to unveil a sweeping decision on China tariffs, which could quadruple tariffs on electric vehicles from China going into the US, although the rumours suggest that they are going to be fairly narrowly tailored to just a few sectors like EVs and solar panels and batteries. But what's your reaction to that?
Well, China is the world leader in electric vehicles, and this is the first time this has happened in the auto sector. Previously, Chinese cars were always behind those from Europe and the US, but now, especially BYD, it's the world leader. And for the last 20 years, BYD and the other Chinese manufacturers have invested very heavily in R&D. They've received a lot of subsidies from the government, so they're way ahead. And the European and the American manufacturers have not done this investment and have not done this R&D. So they find themselves a long way behind. So the the auto industries in Europe and the US are pressing their governments to give them protection, because at the moment they can't compete.
So this is pure protectionism, really, isn't it? It's not about overcapacity, because there's a huge market for electric vehicles for Chinese, American, and European companies. This is just about protecting the domestic US industry.
Yes, but you see the position of the US government and the European Commission is that the Chinese auto capacity is, I think it's 41 million cars a year. So it's 20 million sold in China, 3 million exported. So there's a huge capacity for which there is no market in China. So this drives Chinese companies to export their surplus production. And the US and the European Commission say that this surplus capacity is completely man-made. It shouldn't exist. In a market economy, you would not have production capacity almost double what the domestic demand is. So that they want to protect their manufacturers from what they consider this unfair capacity. So that's true, but what you've just said is also true, that the Chinese makers are technically far ahead of the European and American makers in EVs.
I mean, that data from the European Chamber of Commerce, it basically says that China has 60% now of the global manufacturing capacity, 31% of global production, and about 14% of global consumption. So clearly, its manufacturing capacity is well ahead of what it can actually consume itself. So that difference of about 27 million has to be exported, and it equals the entire production of the US and Europe. So when you sort of put it in those terms, it's a question of scale, really, isn't it? We haven't really seen anything like this in the auto industry before.
So on Monday, President Xi Jinping met Emmanuel Macron and Ursula von der Leyen. And this is what those two said. They said, we have a major auto industry in Europe, especially Germany and France, and we cannot allow it to be crushed by these surge of cheap imports. So that was their argument. But they got no comfort at all from President Xi. He said, we have no overcapacity, that our excellence in this field is a result of our own efforts, our own investment, our own R&D, and we have no overcapacity. So he indicated no willingness to compromise or put any export controls from the Chinese side. But there is a difference between the US and Europe in that Europe welcomes Chinese companies to invest in Europe and make EVs and green energy products within the EU. So in Hungary, CATL, the world's biggest makers of car batteries, is building an enormous plant there. And so I expect that the Chinese EV makers will establish production facilities within Europe. And of course, for the EU, that's an acceptable outcome, because it means you have European workers, they pay European taxes, and it gives the European companies access to the technology. Whereas I think the US is different. They don't want EV manufacturers to come to the US.
They want to expand their own production. But how is this issue then with the EU going to get resolved? Because Ursula von der Leyen is saying, we're going to protect China, our economies, we're going to protect our companies. President Xi Jinping is saying there isn't an overcapacity issue. How do you square that circle? Is the answer for Chinese companies maybe to do what it's doing in Hungary and invest more in other places around Europe, or is that not going to be enough?
So I think the two things will happen. One is the EU is doing a review now of whether EU production in China is subsidized. And at the end of the review, which I think will be September, we expect there to be tariffs. I don't think it'll be 100% because that's very drastic. I expect maybe 25 to 30%. So that would be one answer. The other answer is I think the Chinese companies themselves will, analyze the situation and decide, yes, we'll make factories in Hungary and Germany, in the big markets in Europe. I think those will be the two outcomes of this dispute.
The thing is, though, at the end of the day, it's not really going to harm Chinese EV manufacturers that badly, is it? Because there's a big market globally. They only export about a third of their cars anyway to developed countries. 2/3 of it goes to the emerging markets, the developing economies. So presumably they will just expand there. There's still a very big market for them.
Yeah, and of course, history is on their side because developed countries now have these targets for when all vehicles have to be clean energy vehicles. Petroleum vehicles are being phased out. So the long-term outlook for BYD and the other EV makers is extremely good. So, I think they've nothing much to worry about. You're right. They've just got to analyze the politics and decide where to put their production, and I think they will be able to export, yes. Mm-hmm.
So this is going to harm EU consumers who are going to have to pay higher prices, and also President Xi is right, isn't it? It means they're going to struggle to meet their climate change targets if they can't import these EVs.
Yes, but of course we must speak about the politics, because in the case of Joe Biden, this election in November is going to be decided in these swing states. I think there are 6 swing states. That's Michigan, Wisconsin, Illinois. These states that used to have a very large, heavy industrial base. So to win the union vote there, he has to make such promises. So in Europe, it's the same. Europe, we have elections this year, and the politicians have to protect the auto industries in their area. So especially Germany, Italy, France, those politicians are under great pressure to offer protection of some sort, if not for a long term, but for a short term, to assure their automakers and the auto workers that they will still have jobs in the future.
It seems to me that the EU and the US have picked on the wrong industry here. I understand that obviously autos is a key industry for Europe, but it is true, isn't it, that European auto manufacturers have missed a trick here. The Chinese went and invested ages ago and are now reaping the benefits from that, whereas there are other sectors where maybe the EU argument stands up much better. Things like steel and aluminium, for example. I mean, China's steel production is completely detached, isn't it, from its real needs. It produces twice as much steel as Japan, India, the United States and Russia combined. So there are industries where there is massive overproduction. It's just maybe not EVs.
Yeah, so I'm expecting Biden to also announce tariffs on steel, aluminium, and also other green energy products too. Yes, you're right. China has overproduction in many industrial sectors. So why is it EVs now? My take is that because in Germany, the auto industry is the most important industry. Mm-hmm. Since World War II, German cars have been the sort of pride of Europe. So they've got to protect that industry. So I think that's the reason for the concentration on EVs at the moment.
But we're heading for a trade war, aren't we, between the EU, or an extension of the trade war? You could probably say there is already one going on, but this is just going to fracture the global trading system even further.
Yeah, so I think there'll be a big trade war between the US and China, and there'll be not quite such a big trade war between China and the EU, but yes, it will also be a trade war. And of course, you're right, it's not good for globalization. It means people pay higher prices for the things they buy. But, that's the route that, well, I don't want to criticize both China and the EU. I mean, they've both chosen that route. If the two sides were more able to compromise, perhaps this could be avoided, but they're not.
Mark, it's always a pleasure talking to you. Thank you very much for joining me this morning.
Thank you very much, Peter. Anytime. Bye-bye.
That's China specialist and author Mark O'Neill.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Richard Harris, Chief Executive Officer at Port Shelter Investment Management, Nick Marrow, Lead for Global Trade at The Economist Intelligence Unit, and in Washington, D.C., our US economics correspondent, writer and broadcaster Barry Wood. See you tomorrow.
Money Talk.